All right, we are back with the Market Watcher, and first of all, we are going to have a look at the Kenyan shilling, whereby we saw the Kenyan shilling weakening on Friday as importers bought dollars to meet the end month demand for their supplies, and we saw the Kenyan shilling ceding to 85, 85, 95, while the dollar, well, on Thursday, this was compared to Thursday's close of 85, 65, 85. And on Friday's session, we saw the Nairobi Securities Exchange halting a two-day gaining streak, declining by 0.1% to 4,706.80%, while the all-share index eased 0.6% to 109.64 points. With us in studio, we have Rufus Mwanyasia. He is an investment analyst at Savo Securities. Many thanks for joining us. Now, we have seen a lot of fluctuation in the stock market, but looking at it from the perspective of the global market, it's not an isolated situation. How much lower do you expect this to continue fluctuating?
Well, I think investors are getting jittery from an international point of view. I think with the so-called tapering of the U.S. government buying of bonds, that is tightening up liquidity. So you're seeing that it kind of cascading down to emerging markets and even frontier markets like ours. And guys, you're seeing the markets the way it's reacting. With the pullback of cash. The momentum is starting to decelerate. So as you saw last week, 2% down. So I think if the trend continues, then we're likely to see perhaps maybe the market dipping to above 4,300 there.
That low from 4,700 to about 4,300? Yeah,
sure. Because what happened last week was critical, because we violated. Let me put it this way: that we broke below a very important support at 4,700, and this was a support level that has held the market for the last since March, so a couple of months there. So the breaking low the breaking downwards of the price index really opens up the downside risk. So I guess we might see a bit of retracement. To an extreme view will say we might lose about 400 points there. So 4,300, yes, we can actually.
The fact that we're not seeing money coming in, now that there's tightening happening, in the global market, which are some of the other sectors that you actually see probably, having the most need for cash?
Well, I think the retail sector looks quite okay. And I'm just looking at it from a macro point of view. Middle class, increasing within the country. Inflation rate is, at its lowest in the last 12 months, and I think that leaves a lot of disposable income for guys, to walk in, and we're going to see more traffic in supermarkets, and that in itself will, gives it a very optimistic outlook. Another sector that I'm also hopeful about is the oil industry. Or let me say energy, because the price for oil has really stabilized, and is for a long time is now trading below $100 per barrel.
So in that case, we're looking at Kenel Kobil, looking at Total.
And Total, exactly.
Kengen, is it likely to fall in that, because once in a while they do use thermal generation? Yeah,
sure. Yeah, you might say that you're going to see a bit of a positive impact on the price, because we know 40% is generated by diesel. So with the prices coming down, I think there's going to be some good impact on the price.
You just talked about supermarkets, and before we had Jonathan Siano, the Chumi CEO, and he's talking about expansion into the region. What are your thoughts into their growth into the region?
Well, I think it's the right move. We're expecting growth in the region to be in the excess of 5% and plus growth percentage-wise, and I think it's the right move to take advantage of that kind of growth. Well, maybe in my view, I'll say it has to be a very cautious move, in view that during the last time when they expanded too rapidly, they started having some cash flow problems. So I guess I'm sure maybe with hindsight, he's keeping tabs on that, and I'm sure maybe perhaps he'll do well.
Though he was not at liberty to tell us about how his second half might perform, and we saw the first half tumbling about 35% in terms of profits. For you, what are the sentiments that you have on how the second half is likely to perform?
Well, I think Maybe in view of the fact that inflation, general prices generally came down last year, I think we might see a bit of good results on the top line. Well, I think perhaps I'll be interested to see on how the operational costs look like, because they're still way on the higher side compared to their their peers.
Yeah.
So I guess that would be interesting. But I think generally my take would be I think they're going to have good results.
All right. Looking at Kenya Commercial Bank, and now seeing them in the second phase of restructuring, whereby we've seen some management shake-up, some of the news that were coming in this morning. What are your thoughts in terms of how they are managing their costs?
Well, for KCB, looking at its operational cost against its income, it's one of the highest in the industry.
At the moment, it's standing at above 50.
It should be above 55%. So I guess I know that the new CEO has a vision of really chopping it down and having a lean kind of a management on the management, and really kind of just trying to cut down on the excess fat, if I may call it that way. I think it's needful, because I think going the way the industry is behaving right now, you need to be lean and responding to to the market as fast as possible. Exactly. So I guess the strategies are good. They're going to be painful, but I think that in the long run they're going to be very helpful for the bank in terms of putting a lid on its costs.
Looking at the banking sector in general as a whole, we have the rates coming in at still very high rates. When you look at the cost of borrowing, the credit rates are still a double digit. When you look at the debt market, we have it at 5%. The benchmark for interest rates, the 91-day T-bill, is at 5.1%. Yet the banks have stubbornly failed to reduce the lending rates, and this is something that has been raised as a concern also by Treasury, because they're not spurring economic growth. For you, what are your thoughts on why the rates are still stubbornly high?
Personally, I don't see the reason why they should hold those rates very high. As we speak, for the last 2 decades, the interest rate spread has remained above 10%. Lending rates have never gone below 15%. And while saving rates have gone down from about 5%, right now we're talking about 1.65%. I guess like for the last 2 years, we've seen credit risk, which is the most important risk factors that the banks consider, has moved from about 9%. Right now it should be about below 7%, but still the banks don't bring down the rate. So I guess this is a question that maybe should be settled politically. I don't know why.
All right.